comes the money.
Here we go. Money talk.
Here comes the money.
Welcome to the Free Money Podcast. This is a pretty special episode, right, Ashby?
It is. We desperately need something. What do we need?
I mean, well, I think a lot more people have been listening to our podcast since we started getting guests on. And so I think in this episode, we've basically gone, let's do 3 guests.
That's right. And the first 2 guests are going to happen right off the bat here because they've both had birthdays and their dad agreed as part of their birthday present to put them on the Free Money Podcast.
I'm so excited. This is going to be our best episode ever.
Should I bring them over?
Oh, yes, please.
Henry and B, I've got 2 kids, Henry and Beatrix. Henry just turned 10.
Whoa.
And B's birthday is today. B and Henry, welcome to the Free Money Podcast.
Hello.
Hi. You guys are the stars of the show. What do you think of the Free Money Podcast?
Well, I mean, it's pretty cool. Yeah. Because, Dad does all this stuff about, isn't it you talk about the coronavirus and
we do. Yeah.
Finance.
We try to
stuff
make
like that.
We try to make finance fun. Have we
finance.
achieved it?
Yeah.
Yeah.
Partially.
What do you think, B?
I think I'm the same as Henry.
Sweet.
So what would you guys say that your dad actually does for a living?
Thank you, Sloan.
I mean, he works to make finance fun and works to make the world better. Basically, the world better.
Yeah.
That is pretty on point, I think.
I appreciate that, guys. I'll be giving you gifts later for saying that.
Exactly.
So Henry and B, happy birthday. You just both had these birthdays during the midst of the COVID. While we've got you here, how different do you think your birthday was this year as compared to last year? Henry, why don't you start and then B?
All right. I think my birthday was bad and good.
Okay.
This year. I mean, the bad part was that it was during the coronavirus. I couldn't have a sleepover or any play dates on, the past few weeks, or actually, I think months.
Yeah, 4 months.
So it's been really hard to, keep in contact with the people I love and are friends with.
Yeah.
So that's a problem. But the good part is that I get lots and lots of iPad. I get to eat a lot of stuff I usually don't get to eat, like snacks, gummies, all this stuff. So it's a bit...
So there's good and bad.
There's good and bad, yeah.
All right.
Gummy bears are great. I totally agree with that.
You like your birthday?
The bad thing about coronavirus is that you don't really get to see your friends, and if you do, you have to set it up on FaceTime or Zoom or something.
Oh, brutal. Yeah. Is there anything good that's different this year, or?
Well, one thing is that the coronavirus made us get a trampoline.
Whoa! You got a trampoline? Yeah, legit. Who built it?
You did?
Yes.
My dad, Thierry, and Mom built it.
It was insane.
Awesome.
And we we've only had one near broken bone, which was by you. Yeah.
Me.
Oh, wow.
Jumping on the trampoline.
Exactly. All right.
It was made and it was built all up, but it was incorrectly built.
Oh,
awesome.
Man. Ashley, you
well,
know better.
guys, love you. Happy birthday. We'll have you back on the podcast next year on your birthday again. Hopefully not in COVID.
Okay.
All right. Take
Happy
care.
birthday.
So that was the kiddos.
Oh, my
They've
gosh.
now officially been on the podcast.
Oh, man. I'm jealous of your trampoline. That sounds pretty fun.
Dude, it took 12 times to build it. They're serious projects.
Yep.
And there's a wall going up the sides to prevent broken arms. But if your kid goes and bounces on it before you get the wall built because he's so excited that the trampoline is almost done, and then happens to bounce off the edge of the trampoline, almost break his arm. Kind of defeats the purpose of the wolf. Anyway, it was insane. Ready. He jumped on it. He fell off. We had to take him to the ER.
I think I was reading on Reddit. There was like this thread about like, what do people in your profession hate more than anything else? And one of the most upvoted comments was, "I'm a pediatrician and we hate trampolines."
Hilarious.
But I think Henry nailed the theme for the show, the bad news, good news.
Yeah. They nailed it. And there is so much bad news.
Yeah.
But it's like with these crises, you obviously have opportunities for remaking something or innovating. And with all these bad things going on in the world, who knows? Maybe there are some new and interesting things. Maybe not a trampoline level of good, but we did have one episode with Todd Baruch where he was like, "This crisis is going to help us solve climate change."
Yeah.
So who knows?
Yeah, exactly. Like, I think part of the weirdness about like the concept of uncertainty in economic dialogue is that like, when have we ever had certainty?
Right.
Like we had the clear there is no alternative narrative at one point to investing in risk assets. We had I remember very well going to a bunch of conferences called Investing in a Low Return World.
Yeah.
Remember that?
That was like just before the returns went through the roof, right?
Yep. Yeah, exactly. So we should probably examine the notion that there is ever some sort of certainty, but like it feels particularly whipsawy right now because like, and I don't know if this is just the bubble, right? Like I live in New York City. A quarter of New York City renters have not paid rent at all since March.
Wow.
Which is insane. Like, I mean, like there's literally a quote from a federal agency that says it would take something on the order of divine intervention to keep the situation from worsening. Which is like, I mean, separation of church and state. We can talk about that, but it's a heck of a quote. And then there's like the BCG or I think the Census Bureau actually found that like across the country, 13% of renters had no confidence that they would pay their rent, and 20% have only slight confidence. So that's roughly the same number. 1 in 3, folks who have a rent payment coming up don't know how they're going to make it. And then about half of people, according to BCG, like 58% of Gen Z, millennials, 46% of baby boomers are worried about their personal finances due to COVID. Like that's a pretty bleak picture.
Yeah. No, I mean, some of the listeners might not know this, but I started a company 5 years ago called Long Game. Co-founded it with Lindsay Holden, and she's CEO. And the whole idea was to help people, young people manage their finances. And we've witnessed a lot of the money coming out of the buffer accounts. We provide buffer funds, basically personal sovereign wealth funds, you can call it. And money's been coming out, and that's the bad news. We did see a huge uptick around the stimulus. A lot of checks getting deposited in Long Game, which we perceive to be actually a good use of that since we provide these buffer funds. But the flip side of that negative story is the good story, which is a huge amount of engagement. So since COVID, we've seen 30% more games played in Long Game, which is kind of astounding because we were already a highly engaging app in the App Store. Like the average user on Long Game is playing a game a day. Well, since COVID, maybe people are staring at their phones more, whatever it is, young people are finally engaging in their finances. And so, we have this like terrible data around ability to repay rent or pay mortgages. Maybe it's going to trigger, higher levels of financial literacy or greater levels of interest in their own financial future. I'm not sure.
Yeah, I mean, like I think that's fascinating. Like, definitely there's some weight to the thesis that people are sitting on the couch and thus they want to play, the fun sorts of games that Long Game has. But I think that really there is a lot of attention being paid to these like fundamental, like how you're constructing your personal like life sort of questions, like the I spent a bunch of time with a BCG report this morning that basically took the thesis that what's happened in China, like China is experiencing what the rest of the world is experiencing 2 months earlier, right?
Right.
They're opening up. So we can look to the Chinese consumer to tell us a little bit about what we might expect from the American consumer, from the European consumer. And what they found, this is a shock, right? People are trading up to buy more fresh and organic food, to buy more nice stuff for their households. And half of them say, I can't wait to start traveling again.
Really?
Yeah. Which, I'm certainly in that camp. I very much miss,
Maybe I don't miss like trips through Salt Lake City on my way to Chicago, but I definitely miss trips to like Sydney, or Melbourne, where, you're experiencing like a lot of really interesting meetings and things that just you can't do over Zoom calls. So
yeah,
I'm with you.
Yeah, exactly. I think like, so it's, that's like, that's hopeful, right? I had been worried at the outset of this thing that people are just going to react to it by just basically being traumatized.
Yeah.
And shutting down. But like with all these like kind of cross-cutting wins, what's the macro narrative,
No, I agree. Like we can look at the world and we can see, just in terms of like the birthdays I've had to like develop.
Yeah.
Like it's completely different than last year, right? They didn't really.
And at the beginning of this, like I was like, "Holy crap, Ashby, you got a haircut!"
I know. Oh, and by the way, I am wearing free money merch right now. I've got my new T-shirt, OMG GOP WTF, at the free money available at the Free Money Atelier.
Yes, yeah, and a link for that will of course be provided in the episode description. I've also got my top quintile snapback right here.
Exactly. But I guess my point, aside from plugging our amazing atelier, so much is different, right? Like my kids' birthdays are different. My experience working at Stanford is different. Like,
yeah.
And so what does that mean for like the American consumer or the consumer in general? Like where are we headed, and how are all these industries that rely on these consumers going to be affected? That's like the big question I think a lot of us are wondering about.
And like for better or worse, when we say consumer, what we really mean is debtor.
That's right. Yeah. Because 60% of Americans are in debt.
Yeah. Yeah, exactly. And like, debt service payments are about 5-6% of personal consumption expenditures, right? And like that difference, it makes a huge difference in aggregate consumer spending. So let's call someone.
Let's call my friend.
Let's call Perry.
We're calling Perry Rahbar,
Perry, right?
Who's the CEO of dv01, which is an analytics platform. They're basically the top data and analytics company around lending, personal lending, mortgage-backed security. They're doing it all.
dv01 is a great name too. Dollar value of basis point.
Exactly.
Hello,
Perry. Hi, buddy.
How you
Hey.
doing?
Welcome to the Free Money Podcast, my friend. Thank you for picking up the phone.
It's great to be here. How we doing?
We're doing good. So I was just, what we've been talking about for like the first 10 minutes of the show here is like what is happening to the American consumer and specifically debtor through the COVID. And really, we just wanted to give you a call because we've seen some of the amazing reports you've been putting out through dv01, and also just the fact that your platform has unparalleled access to the data. So Sloan, why don't you jump in and ask our first question, and then we'll get Perry telling us all the wisdom.
Yeah. We're hoping maybe you'd have some sort of a narrative for this. We're looking through this sort of good news, bad news situation where like boosted unemployment, that $600 extra benefit that comes through the pandemic unemployment insurance program, and the PPP loan program are both likely to run out at the end of this month. And just for starters, we're sort of curious, like how much those programs have been supporting consumer debt payments and debt payments in general.
Yeah, well, no one truly knows the answer to that, and that is the would say, multi-trillion-dollar question, right? It's definitely playing a role, because if you would kind of, let's just say a year ago, describe the scenario that we would encounter through COVID, and then ask people what would happen to consumers and how would they respond in their loans, you would have gotten some pretty draconian responses. And I think what we've seen has been surprising to everyone. But then when you step back and think about it, it's not that surprising, in the sense that, going into this, if you kind of go back to March, people are starting to get tax refunds. They're, then all of a sudden this happens. They're locked in their homes. They're not spending money on anything. They get a $1,200 check. And then even if they do lose their jobs, they're getting these unemployment benefits. And people have kind of kept up with their payments for the most part. Yes, people have asked for modifications. And so, what we particularly focus on, where we've done a lot of our work, is on consumer unsecured, which is probably the loan that people would have assumed going into this would be the first thing that people would stop paying. And what we saw that impairments, what we describe as a combination of delinquencies and modifications, peaked right around 15-ish%. And most of that being from modifications, not really from delinquencies. And, most of the modifications are payment deferrals. So, skip this 1 month, or skip 2 months, or skip 3 months, somewhere within that range. And what we've seen is, so far, people who have taken those kind of payment deferrals, let's say, on the 1 month cohort, over 60% of them are current again. And over 40% of all modifications are paying again in current. Some of them have asked for, they come off one mod, they'll ask for another extension and so forth. So, but you haven't seen delinquency spikes yet. And that's what we're really, waiting to see is how that plays out. And obviously the stimulus will have a huge factor to play in that. But you would have assumed that if you were a consumer and you were really scared, that maybe you would start saving money and stop paying some of these loans sooner. I don't think people are just going into this totally blind and saying, I'll just pay these till I run out of money. So no one really knows. And I think we're all waiting to see kind of like, for us, the first report that we'll try to put out, or the first glimpse of it we'll have, is probably the second week into August. Because, then we'll have 1 week in August when the payments run out, the stimulus benefits run out. But really, I think we'll have a better picture of this by the end of August. And then also, if Congress comes together and they extend the benefits, then altogether, I think this could be avoided.
So one of the things I heard you mention, consumer unsecured, is kind of the one that you flagged as like the one that we should all be kind of tracking. That's kind of the purview, as far as I know, and you can correct me, of the alternative lenders out there. These lenders that didn't really exist during the last financial crisis, Prosper, Lending Club, Upgrade, all these new kind of what were once thought of as peer-to-peer, but really weren't, lending platforms. Do you see, anything particular about the alternative lending space that may shake out as a result of this crisis, given that they're the new players?
I see a positive story for this cohort coming out of this crisis, which is, and Ashby, we've talked about this in the past. I mean, people were so skeptical of these originators, right? The idea of a consumer taking a loan out online with a company that's not their bank, and no relationship to them, no loyalty to them. I think a lot of people in the capital markets crowd that were evaluating these loans for many years were just very skeptical of the borrower's commitment to paying that loan if we descended upon some sort of economic uncertainty. They just figured people would walk away from these loans. Maybe there was a little cynicism held over from the financial crisis where people just walked away from mortgages and threw the keys back and so forth. But that was kind of the assumption, that these guys were never really recession tested. And I think the question is always kind of like the metric that we kind of keep in at dv01 in these reports that we're looking at to say, are we doing well? Are we doing poorly? Is really kind of how are these impairments, again, the delinquencies plus the modification rates, compare, like what percentage do we see of total impairments, and how does that compare to unemployment? And so far, the impairments in online lending consumer have tracked below unemployment. And prior, the expectation was it would be multiples of unemployment. So I think they're, holding in fairly well. Again, now it could go off a cliff just based on the stimulus, but one of the things that we talk about is that there's not like some psychological difference between these loans because they're taken out online by a lending company that's not your bank, where you just don't care about them and you walk away from that. So you're really, they're being judged from a pure economic standpoint. And, the same way that you would judge credit cards, auto loans, or mortgages, right? It's not like you don't have this kind of weird kind of technical around who the originator is that might impair performance in a way that you can't really quantify from an economic standpoint. So I think that's a positive. So, one of the things that investors kept on saying is these guys have never been recession tested. Now they have. They've held up pretty well. They've held up in line with the rest of the market. Actually, shockingly, they've done better than non-QM mortgages. So, we also track non-QM mortgages, and we've seen a lot of non-QM being stuff that doesn't qualify for Fannie Freddie, which is mostly going to self-employed borrowers through, alternative kind of documentation types, not your traditional full doc employer verified loan, right? This is alternative documentation using tax returns, bank statements, and so forth. And, we've seen impairments there go approach close to 20% plus.
Wow. That's fascinating and great news for the asset class. I mean, like, I definitely remember that cynicism super well. But, I'm curious in terms of like moving away from the aggregate view and looking at like individual borrower characteristics. Have you seen anything significant emerge with, like, for instance, people who own their homes versus people who don't, or any other kind of meaningful splits on any other characteristic?
Yeah, there's been a few. I mean, one is that, the originators and their grading systems, they're doing a pretty good job. And you could see that, they are good predictors of risk for the most part. FICO is still probably one of the strongest predictors of risk, which, after all these years of bashing FICO, it's held up pretty well. Interestingly, what hasn't played a role is income. And that was another thing that we looked at in terms of the performance of these loans, where people are talking about the stimulus check. Well, a lot of these, when you look at some of these originators, the average income is above that threshold where you were getting, what was the threshold? Was it in the 70s or 80,000 in income a year where you're getting the $1,200 check? So, the actual stimulus check probably wasn't a big driver of performance in this space, because the average income was above that. But home ownership was a pretty good indicator of performance. So, what we've seen is that impairment in homeowners was 3 times less than renters. And they also, when you look at where impairments peaked and then the recovery. So if anyone asked for a modification in that owned a home, they kind of recovered quickly and fell like 200 basis points, 250 plus basis points from the top, fairly quickly. And most of that, I mean, it makes sense when you step back and you think that if you own a home, you probably want to use this moment in the rate drop to refinance your home. The last thing you want to do is ding up your credit on a personal loan. And so with the modifications, they're not reporting them to the bureau. So you could afford to maybe skip a month or two, but then you don't want to actually go delinquent. So home ownership has definitely been a good indicator of performance. There's definitely been a variation there from renters.
Fascinating. I'm just listening to you. I think the big question I have, which is a little bit off topic, is more before COVID, post COVID lending activity. So I know that dv01 it tracks all of the unsecured consumer from alternative platforms, but you've also built a huge program around mortgages. I'm just curious. One of the big things we've been talking about on this podcast is like how COVID is going to change the financial services industry. Do you see the loans or the mortgages coming out of financial services as being different in any way post-COVID as compared to before?
Well, so it's interesting. They're both affected in different ways. So I would say the thing about the consumer personal loan space is it's extremely agile. So meaning, these guys could shut off and turn back on very quickly. There's not much machinery to get it up and running, right? It's really just about spending the money to acquire the customer, and then it's purely a lending decision, and then the loan closes in a number of days. It's really more about, do you have the end buyer of the loan to fund it? Because most of these originators online are marketplaces for the most part. They're not really balance sheeting these loans like some of the brick and mortar guys are. So, for those guys, it's a function of performance and, where is the market in terms of taking on that risk right now. And I think there's not really a consensus. It hasn't totally shut off, but originations are down, from where we were last year, north of 60%. So it hasn't really turned on. And some of them, like, I think Lending Club made it public. They in April were down 90%, right? They were down to nothing. And again, obviously it's a riskier loan, when you think about it, and it's not collateralized. So there's a little bit more risk. The mortgage world, it's a little bit of a different problem. So I think for the most part, what we've seen is that, it was such a violent whiplash type injury to the mortgage market, where it was like a hit and run. The car got hit. It's pretty much demolished. It needs a lot of work, but like you don't even know what hit you because everything repaired very quickly. So a lot of the mortgage market was funded from, credit facilities from Wall Street that were marked to market, and there was crazy price action, and everyone kind of got margin called. Everyone shut off originations. Then once you shut off originations, to get the whole machine warmed up again and ramped up, and you start producing loans, and you get all because again, it's not like direct to consumer like these online lenders. You have conduits. You're a mortgage aggregator. You're buying from countless different originators. You have guidelines with all of them. You have pricing sheets. But the pricing and the risk tolerance in the mortgage market it's just there's no product. And so all these like non-QM originators are slowly ramping back up, but they got bruised. They lost a lot of capital. A lot of them were mortgage REITs that got crushed in the public markets, right? If you go look at most of the mortgage REITs, their stocks are still at down 60% from where they were. So there's a lot of market recovery. Well, at least from a pricing standpoint of where the bonds or the loans would trade, it's pretty much back, but the whole machinery to kind of ramp up originations again is not there. So, I mean, that's actually bizarre to me that people are back to close to old guidelines. You would have thought things would tighten up, but it was just a very tough thing to solve for, right? It wasn't actually a credit problem with the product. It was just the whole market got broken.
Is this narrative? I mean, like that's a crazy, fascinating, like kind of evaporation of liquidity for new originations of these products. I mean, is it really as simple as just folks are being stressed in other places, and so money's gone elsewhere, and we sort of need to wait a couple months for this stuff to heat back up, or is there anything like folks who listen to this tend to be sort of asset owners? Does this sort of imply an opportunity for them, in one space or another?
Actually, the sad thing is, and I think this is what's frustrating a lot of people, is the answer is no. Things were distressed for 2 weeks, and so like you had this like 2 to 3 week distress period that destroyed the whole, mortgage origination machine, and then left no real opportunities. So now you just have like an asset shortage with, and then overlay the fact that the Fed pumped as much money into the system as they have. So like people are pretty desperate for assets with no supply. And that's another bizarre feature of where we're at right now. And I think, what that's done is it's left pretty much everyone in the capital markets pretty burnt out. Like I talked to a lot of people in the mortgage world, and it's just kind of like a, frustrating experience, because you're back to where you were almost a couple of years ago, where you're building up these programs again. Where we were in the mortgage market and the non-agency market in particular was, there's a vibrant non-agency market finally, that was going to probably pump out 20 plus billion in securitizations this year, and maybe north of 50 billion next year. And then also now you just saw kind of some of the rule changes from the CFPB around the QM rule and so forth, which would have been another positive tailwind for the market. And then, this whole thing happened, and you had crazy whiplash in 3 weeks. A lot of things got broken, and now it's going to probably take till the end of the year for things to get back to, somewhat normal. I would say still probably way less than where they were. But but that's still positive, because in the scariest moments in the April, there was this potential where a lot of these originators are, non-bank originators, or their mortgage REITs that were accumulating these mortgages and then issuing the securitizations. A lot of these guys were on the brink of going out of business. So that didn't happen. And then people were like, this is the second time this has happened to this market in 10 years. People are going to walk away from it. And, that's not happening either. I mean, deals have been done where people finally cleared loans off of their balance sheets, and, pricing wasn't horrible. And I think people are getting deals done, which is, 2 months ago, you couldn't do anything. So it's just been a crazy, volatile roller coaster run. And I think it's frustrating for a lot of people involved.
I bet. Definitely. I think the last question I have for you before we let you go is, you built this company, dv01. I'm sure people don't necessarily know your background as well as I do, but you were, a trader at Bear Stearns, and you went off to build this new company to bring data standards and kind of good governance to the Wild West of lending, which was, the peer-to-peer lending space, but then the mortgage space. And I think the reason we really jived was this notion that your type of platform could bring standards to this area that big long-term investors could deploy capital in, and that kind of long-term capital flowing through into these assets is something that many of them want. They want these exposures, but they're just not getting. I'm curious if you've been building this company for 5 years, you've kind of dominated the data space. Are you seeing the big long-term investors moving in finally, like we talked about in that diner 4 years ago in New York City, or is it still is it still not happening?
Well, I think for us it's a tale of two markets. Consumer and online lending is where we started, and that's where I think we're an integral part of the market infrastructure. And I think, for us at dv01, what's been really kind of awesome to watch is, when we started the company, when I first spoke to you, there was a big part of the pitch was not repeating what happened in the financial crisis, and, really being there for the market when we hit another type of crisis like that. And, as we kept going another year away from the financial crisis, sometimes it did feel like the pitch was falling on more deaf ears, because people felt like it's impossible for something like that to happen again. And then this happened, and it happened in a matter of weeks and flipped the whole market upside down. What was really awesome for us is the response that we were able to put in place. And, by the end of March, having performance data on what's going on in the consumer market, I think we played a big part in bringing transparency to that market and giving investors confidence in the asset class. And that asset class itself had attracted some of those investors. I would still love more of your crowd to get into the mortgage market and the consumer market, and and dv01 being playing a role in getting them comfortable with the data that's going to be available to them. So we've done, and it's amazing to see how well and orderly this has all been in consumer. And again, so no one's no one's messing around with nonsense. They're thinking at a higher level about their macro view of what's going to happen to the consumer, and not I can't understand how it's playing out in any of these bonds or loans and so forth because I don't have the data. And that's just not even part of the question. Now you go to the other side where we operate in the mortgage market, and it's a way more old school market. And you might even, common sense would say that those people should be more open to having us in because they dealt with the crisis before and it didn't go so well. But that's where we hit some status quo. So, whereas in online lending and consumer, dv01 has almost 98% penetration. In non-QM mortgages, we have 30 so far. Okay. And it's a newer effort for us, so we're just kind of earlier on that path. But, we're uncovering so many reporting errors across trustees and servicers and mods not being reported properly and so forth. And it's still a mess to a degree. And so, it's just we're making progress, and it's just amazing to me that actually the more mature market's the one that's more backwards in terms of its reporting, and it's just more status quo. But I think what we always say to all these guys is, if you want the same investors that you've dealt with for the last 20 years, that's fine. It's just a smaller pool. But if you want to bring in bigger pools of capital, transparency is a big part of that. I thought the consumer online lending guys did a great job of that by just saying, here's all the performance data to anyone that was interested. And it plays a big role in making people feel comfortable. These markets are still, structured products still hasn't fully gotten rid of, the scarlet letter on its chest from the financial crisis by any means. So I think the data plays a big part of that. Are we fully there yet? No. But I think we've really proved how efficient a market could operate with the consumer market, which you would have thought in this environment is the market people would be running away from, but it's actually been fairly orderly.
Well, that's the good news. I mean, so much of my life's work, as you know, is like around trying to bring tech and data into like the most antiquated, conservative, bureaucratic organizations. And so it's great to hear that when an industry is an upstart, it can leapfrog, and actually the data and technology powers kind of a next generation, level of risk management, portfolio knowledge, attribution of returns, and that you can get through crises. So it's kind of like it's making the case for all these other segments to kind of get their act together, hopefully.
Yeah, it's kind of amazing that like we were, the sort of bear case on these online loans was that, the platforms wouldn't be able to keep up with these established lending standards.
Yeah. I mean, it's easy to, you could come into our platform and look in consumer and understand what types of bonds were made, how long were their durations, what the repayment looks like. In the mortgage world, we're still spot checking whether or not a servicer, like you could find a loan, it didn't make a payment, not delinquent, but there's no mod reported. And it's like, it's obvious something happened here. Like, I mean, it's just, it's crazy how there's still a lot of auditing and going on. And then you look at the trustee report and we know that number's wrong. And it's, but it's just, there's a certain level of apathy when it comes to these markets that have been operating a certain way for so long. It's just no one has that vested interest. So Ashby, I mean, this is something that we bond over all the time. This type of work and trying to get these institutions to change is not for the faint-hearted, right? It takes a lot of persistence. It takes a long time, and eventually, you start to build momentum, and you get there. But I think this has been great, and for us personally, just in terms of giving people a sense for what is possible. The reports that we put out, and they're on our website at dv01.co, you could see. I mean, this is real-time transparency into consumer behavior, and that's not even something that's often possible in structured products because there's such reporting lags. But I really applaud the online lenders for how they changed their reporting standards and the data that they made available to vendors like us.
It's awesome, Perry. All right. Well, thank you so much for and giving us the details and sharing all the knowledge. So we'll let you go and have a great weekend.
Back in August, and we'll let you know how everything's coming along.
Oh, yes. Looking forward to that. Thank you so much.
All right. Take care, guys.
Bye.
Bye.
Perry's great.
Some more good news and some more bad news. I love it.
Well, isn't it awesome? First of all, he's just one of the smartest people I know. And it's awesome to see the industries with the good data and the good tech in finance kind of doing the leapfrog thing. And for the listeners out there who would have thought that like the mortgages had good data or that the service providers and banks were doing a good job of like reporting on all the things associated with your mortgage, like it's still so dysfunctional, and people like Perry are trying to bring functionality to this dysfunction, but it's still really hard.
Yeah. I mean, like, I was really surprised. I mean, like, this is the ultimate anecdata, but like when I bought my car, I was like, maybe I'll get a car loan. Let's see, interest rates are low. And it turns out they underwrite car loans based on the year of your car. So like, not based on your credit. It's based on like, so I bought like a 2007 Toyota, which, they said meant that I needed to pay like 1,500 basis points in loans. So I went to an online platform and I got literally, I got like a weighted 2% for it.
Oh my gosh. Yeah.
I mean,
well, this is all part of like the new world of alternative data and alternative credit and how we score individuals and businesses and houses, and it's like most of the financial services industry is operating in like a 40-year-old mindset when like there's potential to just do things completely differently. And it's going to require like the kind of data architecture that Perry's building to give people a sense of like what's happening as a market. But once we have that, the hope is you can then, build all these new models for understanding the consumer, the lender, the borrower, and build new pathways to, I don't know, help people get the capital they need.
Yeah. It's also really interesting that FICO is still going strong.
Right.
Yeah. I mean, like my sister's boyfriend writes about credit card points and how you can do cool things with them. So they just got a new kitten and named it FICO. And I was kind of like, I don't know. I mean, like maybe FICO will get disrupted, but I'm glad to see that, the kitten, at least for the life of the kitten, FICO will be around.
Yeah. Well, good news, bad news. Good news, those alternative lending platforms, maybe they're not so alternative after all.
Yep. Yeah, exactly. But, with all that said, it is time for Dear Ashby. Boop, 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 boop.
I love that thing.
This is the segment, beloved listener, where we ask questions of Dr. Ashby Monk. If you would like to ask one, just slide into our DMs or our emails, or if you don't have any of that handy, just email freemoneypod@gmail.com. And we'll read your questions and then ask them. Isn't that cool? I think so.
I think it's cool.
Right? Yeah. I mean, and, just while we're doing show business, also, hey, please leave us a review. That'd be nice too. But without further ado, wow, I'm really on a rhyming. Yeah, that's pretty good.
Yeah.
So
that's how you know we don't write the show beforehand. You would have never looked at that series of rhymes and been like, "No, that's going to work."
Oh yeah, that's going to really flow. Like people love that. So the first question is: as yields fall, there's a growing din of discussion about swapping bonds for cash. Like, so a lot of time investment portfolios are 60% stocks, 40% bonds.
Yeah.
And folks are saying like, "Hey, what are we doing with these 40% bonds? Let's trade them out for cash." A questioner asks, "Is this bonkers?"
It can get you fired. You work in a pension plan, it can get you fired, not because it's a bad idea, but because it means breaking from your peer group.
Yeah.
So I don't think it's a bonkers idea from a pure investment perspective. I don't see an upside in bonds right now. I don't know where they go from here. So moving into cash, which seems like it is immune to inflation, like whatever we do to the money supply, we'll just like print money, and it just doesn't seem to affect consumer price index.
Yeah.
I saw like a really funny tweet the other day that was like one of those memes where it was the Orange County chopper, father and son, yelling at each other back and forth about inflation. And it was so funny because they were talking about how inflation isn't showing up in CPI because we have this globalized world. So TVs are continuing to have like the price level come down. But if you look at financial assets, property, or education, that's where you're going to find huge amounts of inflation as these assets get bid up. And so maybe we are seeing inflation happening there, but it's not happening in cash. And so maybe cash is a great place to be. It's not a long-term investment strategy, but if you're looking at fixed income or cash and you're trying to understand like, what are my options? At least cash gives you liquidity, perfect liquidity, that you can then put to work in something else. So it's not bonkers. It would be painful to explain to your board why your performance was deviating so much from the peer group. So, maybe for individuals it's fine, but I don't expect to see a bunch of pension funds or sovereign funds doing it anytime soon. They'd have to change entire benchmarks and mandates.
Just to be clear for the listeners who are not huge nerds, the reason that one would want to do this is that the price of a bond tends to fall as interest rates rise, right? So interest rates now are at near historic lows, the assumption being that they might at some point revert to where they were. So were they to do that, and you're holding cash, you would continue to have assets worth exactly what, you had, like you'd have all this pile of cash. Whereas if you had a bond, you might lose like 10% of the value for every 1% rise in interest rates or so.
And if you're holding cash and all of a sudden inflation does hit and you're worried, the move is to raise interest rates, which then crushes your bond prices. Right? So you may as well just hold cash, even if you're worried about inflation.
That's a good point. Yeah, it's hey, I'm selling all my stuff. I'm putting my cash in a mattress. That's that's the play. This next question is interesting. I think you must have a reputation for being in on some gossip, Ashby. So have you heard anything new about the U.S. setting up a sovereign wealth fund? There's some discussion on the internets, and I haven't seen this discussion actually, that such a fund could be used to address inequality.
I love this question because it blows people's minds in ways that they didn't expect. Here's the first mind blow. The first sovereign fund in the world was set up in the US of A in 1845. Okay, it was in Texas, and I think it was called the Texas Permanent School Fund. And as a country, we already have more sovereign funds than any other country in the world. At last count, we have 11.
That's nuts.
We call them permanent funds.
Yeah.
There's 2 in Texas, Alabama, New Mexico, Wyoming, North Dakota, Utah, Oregon, Louisiana, Montana. I might be forgetting one. But like those organizations were set up by states to manage either, subsoil assets or something, right? The $2 million fund that was established in 1845 in Texas, I think was like a federal grant to Texas as we were actually gobbling up Texas. Not the question that this person is asking, which I think is a great question, which is like, could we have a national fund? And could that national fund address inequality? And then once again, here's mind-blowing, like number 2, we do. It's called the Social Security Trust Fund. It has $2.6 trillion. And in theory, it exists to reduce inequality because it pays everybody an old age pension. Now, it is suboptimal in the sense that all $2.6 trillion are invested in U.S. treasuries rather than
not recommended.
Well, it's pretty low. We just got talking about how you'd rather have your money in cash than government bonds. But so it's not quite, I think, again, what this person is talking about. I think what this person is saying is, could we take the Social Security Trust Fund, diversify the investment portfolio away from treasuries into other things, and could those diversified investment strategies be deployed domestically to alter inequality? And I've heard rumblings, but I've heard rumblings for 15 years. So this isn't the first set of rumbles. The rumbles will become more pronounced under a Biden administration than they will be under a Trump administration. So that's kind of an exciting prospect of having a Biden administration. But like we've seen in other countries that these sovereign funds, if they're permitted to invest domestically, they can do pretty interesting things, in terms of catalyzing new industries. I've written a whole series of papers on sovereign development funds that have the purpose of investing domestically to alter the mix of industries that the country relies on. Usually it's in a case where a country is totally reliant on fossil fuel or hydrocarbon based industries. And so they want to invest in new green industries. And so they have a whole series of mechanisms to do that. The short answer is it's possible, and I hear rumblings. The longer answer is, it would be pretty challenging to pull it off politically, but we can do it. If we could do it politically, we could definitely do it. There's enough cases out there that we know how to design that vehicle and get it to achieve a rate of return that's sufficient, invest in domestic industries. We wouldn't even have to build it from scratch. There's blueprints that we could pull from.
Yeah. So it wouldn't be like a technical problem. It would be a getting off the couch problem.
Yeah. Yeah. Like getting Congress to agree that we need to diversify this. I don't think it's the kind of thing that's just, I actually don't know enough to say, like, could it be an executive order? Could it be a change in regulation, or do we need legislation? It's like those are different orders of difficulty.
Yep. But yeah, I mean, that'd be a pretty crazy executive order. Let's sell $2.6 trillion of treasury bonds.
Why don't we just start with 0.6 trillion?
Yeah, I mean, still, that's a lot of treasury bonds.
No.
Yeah. But hey, I mean, we can hope. Just remind the listener that it's usually 60% equities or, other kind of equity risk assets and 40% bonds, not 100% bonds.
Yeah. Well, the critique is we use the Social Security Trust Fund to, finance domestic programs through the U.S. Treasury. So
to like plug a hole in the budget.
Exactly. And so even there, this may be the mind-blowing moment number 3. Maybe it is actually by providing capital to the budget. Maybe it is already reducing inequality by providing public assistance in some way, shape, or form.
Full galaxy brain on me.
Yeah, it's like 3 moments of sheer explosion.
Whoa! I mean, that's pretty crazy. I never thought about it that way. I've yet another reason to love this segment.
Yeah.
This last one, I mean, someone seems a little bit cynical. Of all the sports that don't seem to be coming back, which do you miss the least?
Oh, this is like just trying to get me in trouble with certain cohorts of listeners, like imagine as a Canadian, if I said hockey, somewhere in my mind, I was like, I don't really miss the hockey, but I can't say that because all my Canadian friends would just crap on me. And so I'm not going to say hockey. I think for me, I just think like the Fight Club that is MMA, there was that whole Fight Club Island that got canceled. For me, it's like just watching people pummel each other is already like too gladiatorial, but having to like talk to my kids about like the insane beatdowns that are like showing up on the sports channel or whatever, it's too perverse for me. So I don't miss that. I think it doesn't have like the history of boxing or karate or it looks and feels egregious, like just dudes beating each other. And
it's literally blood sport.
It's a blood, like, it ends when somebody's bleeding too much. And so there's the part of me that's like, gosh, I'm glad I don't have to like constantly switch the channel when that's on, which I found myself doing with 2 little kids a lot.
Yeah.
And also like, I wonder, these young people that get pulled into that, if they're going to be harmed. Like, we all know football players suffer later in life and boxers suffer later in life. And like those people are wearing helmets in one case and gloves in the other.
Yeah.
And, the MMA guys are just beating each other's ass with knees and fists and feet. And so there you go. What about you?
So I'll flip this on its head. So the best news out of COVID for me in the sports arena is that ESPN has been actually launching the Ocho, which I don't know if you remember from Zoolanders, like the sort of like, specific home for obscure sports. But they've actually been doing that.
They have?
Yeah. And so like, I think I don't have cable, but I've heard reports that if you log on to ESPN on like a Sunday afternoon or something, they'll have, kind of whatever sport they can find. Beer pong, or like they had the World Stone Skipping Championships on not too long ago.
That's amazing.
Right? Like, I mean, that is the kind of thing I want in my sports journalism, right? Like just really arcane, out there stuff.
Yeah, I mean, I was pretty devastated. I don't know if people saw this, but Stanford just shut down a bunch of sports. Did you see that news?
I didn't know. That sucks.
So it's not quite clear if it's COVID or what, but we're canceling 11 varsity sports.
Wow, like forever.
Yeah, gone at the end of 2021. And so we've got varsity athletes that, maybe they're sophomores now that come their junior year. The sport that they came to Stanford to play won't be there.
That sucks.
And one of the sports they're canceling was the sport I did in college, which was rowing.
They're canceling rowing?
Yeah, well, for men. They're not canceling women's rowing. They're just canceling men's rowing. It's pretty devastating. So I was a rower in college at Princeton, and that's painful. But so that's a real one.
That's a real paradigm shift. I mean, I rowed in high school, and there's just so much wrapped into like the idea of the institution and rowing. That's wild that they're actually getting rid of it.
Yeah. Anyway, so that's it. That's where we are with the sports.
Yeah, and the kids these days soon they won't even know how to row an 8.
Exactly. They can't even skull.
Yeah, do you even skull, idiot?
Skull anymore, or do you just sweep port side?
Oh man! All right. Well, that about does it for us this week. We love you very much, dear listener.
We do love you.
Yeah, we do. It's like, and it's it's a real love. It's the requited kind, not the unrequited kind.
All the way to the end to hear this, and so we love you because you're probably one of our parents.
Bye.
Bye.
Let me get rain on them.